Have you ever considered the possibility of a government-induced financial disaster? A notion that may seem far-fetched, but let's take a moment to ponder on it. Imagine a world where the government has the power to induce a financial catastrophe, to shake the very foundations of our economic system. What could possibly be the motive behind such a drastic move? Could it be a desperate attempt to reset the financial system? Or perhaps a bold strategy to eradicate the crippling debt that hangs over nations like a dark cloud? Another intriguing possibility is the introduction of a new form of currency, one that is digital, controlled, and issued by the central bank. A currency that promises privacy, transferability, convenience, and financial security. One that could potentially reduce costs, increase financial inclusion, and enhance stability. An enticing proposition, isn't it? But the question remains, could a government really go to such lengths to cause a financial disaster, only to offer a seemingly perfect solution? Could this be a reality, or is it just another conspiracy theory? Imagine a world where your money is completely digital, controlled by the central bank. This is the concept of Central Bank Digital Currency, or CBDC for short. It's not a concept from a dystopian novel, but a reality many governments and financial institutions are considering. A central bank digital currency is, in essence, a digital form of a country's fiat currency, issued and regulated by the central bank. It's pegged to the value of the nation's currency, aiming to provide the convenience of digital transactions with the stability of traditional money. It's not a cryptocurrency like Bitcoin or Ethereum, which are decentralized and often subject to wild value fluctuations. Instead, it's a controlled, stable digital currency designed for everyday use. The benefits of CBDCs are substantial. They promise reduced transaction costs, making it cheaper for you to send and receive money. They could increase financial inclusion, giving people without access to traditional banking the ability to engage in digital transactions. And they could enhance stability in the financial system, reducing the risk of bank runs and financial crises. But like any significant change, there are potential downsides. One of the biggest concerns is privacy. In a world where your money is completely digital and controlled by the central bank, what happens to financial privacy? Could the government track every transaction you make? And what about control? With digital currency, it would be easier for the government to implement monetary policies directly affecting your digital wallet. Could this power be misused? And here's a thought to stir your grey cells. Is it possible that a government-induced financial disaster could pave the way for the adoption of CBDCs? The notion might seem far-fetched, but in a world of economic uncertainties and technological advancements, it's a question worth asking. There are those who believe that governments could intentionally cause financial disasters to force the adoption of CBDCs. Now let's delve into this theory. The proponents of this view argue that governments, in a bid to exert more control over the economy, may engineer a financial meltdown. They cite past instances where government actions or inactions have led to economic crises. Take the global financial crisis of 2008, for instance. Some argue that the lack of adequate regulation allowed the housing bubble to inflate and then burst, leading to a domino effect that sent shockwaves through the global economy. They propose that this wasn't mere negligence, but a calculated move. Fast forward to today, and we're seeing a growing interest in central bank digital currencies, or CBDCs. These are not like your Bitcoin or Ethereum. They are state-sanctioned, centralized digital currencies. So why would a government want to push for the adoption of such a currency? The answer, according to the theory, lies in control and debt eradication. In a world of CBDCs, every transaction is traceable. There's no cash under the mattress, no unaccounted transactions. Governments would have an unprecedented level of oversight over the economy. Additionally, a switch to a CBDC could potentially allow a government to reset its debt, essentially starting from a clean slate. The theory suggests that a government might be tempted to cause a financial disaster, then step in with the solution of a CBDC. It's a compelling narrative, certainly. A powerful entity causing chaos, only to present the solution, gaining more control in the process. It's a story as old as time, and it resonates with those who are wary of governmental overreach. While this theory may sound plausible to some, it's important to separate fact from fiction. Let's turn to the facts. What do we know about government-induced financial disasters and CBDCs? First off, Central Bank Digital Currencies, or CBDCs, are exactly what they sound like. Digital currencies issued directly by a country's central bank. They're designed to offer a blend of privacy, transferability, convenience, and financial security. And while they share some similarities with cryptocurrencies like Bitcoin or Ethereum, they're fundamentally different because they're controlled by central banks and pegged to the nation's fiat currency. As we look around the globe, we see a growing interest in CBDCs. As of March 2023, 11 countries have already rolled out a form of CBDC, 18 are running pilot programs, and 32 others are in the exploration or development stages. However, it's crucial to note that no major economy has fully implemented one yet. Now, what about the idea of government-induced financial disasters? Well, this is where things get tricky. While it's true that governments can make decisions that negatively impact the economy, there's no concrete evidence to support the theory that any government has intentionally caused a financial disaster to pave the way for CBDCs. Economic decisions are complex and multifaceted, often influenced by a myriad of factors beyond any single entity's control. To suggest that a government could or would purposely induce a financial disaster is quite a stretch, and one that isn't supported by the facts at hand. As always, the truth is often more complicated than conspiracy theories would have us believe. So, what have we learned today? We've delved into the topic of central bank digital currencies, or CBDCs, a digital currency issued by a country's central bank, designed for stability and controlled by the central authorities. We've explored a conspiracy theory suggesting that governments could force a financial disaster, only to offer CBDCs as a solution, potentially eradicating debt. We've also examined the facts, including the current status of CBDCs globally and the US's ongoing research into them. Whether a government-induced financial disaster is a real possibility or just a conspiracy theory, it's clear that the world of finance is evolving, and as it does, we must stay informed and critical.